Well, we're taping this at Thursday afternoon, and as of now, the market seems to be finding a level sort of around Wednesday's close, which was near the lows. We've had some incredible volatility even today, which seems relatively quiet compared to the other ones. Overnight we had the futures higher, then the futures lower on negative headlines, then higher on positive economic results. We've had up and down 15-point moves in a heartbeat in the S&Ps a couple of weeks ago. When things were very quiet, that would have been big news. As of today, well, just seems to be the market trying to find a level. To recap, we saw the market sell off on some bad news on Monday, and it was a pretty nasty sell-off. Then we basically recouped everything on Tuesday on some upbeat headlines about delaying tariffs. And then on Wednesday, when we realized, well, it was just a delay, and then the market really, I don't know if I'm going to say it overreacted to the futures, to the bonds inverting the yield curves, between twos and tens. That's the proximate cause, but obviously that wasn't the reason alone for all this, for the decline that we saw on Wednesday. There's always one trigger, and I guess there were probably all sorts of, programs set up to sell off, take risk off, and I really don't love the term risk on, risk off markets, but to take risk off the table, if and when the 10-year future had a lower yield than the 10-year bond, rather, had a lower yield than the 2-year bond, a 2-year note. But that seemed to be what happened, but it doesn't take much in a fragile market to turn from a selling causality to a stampede, and that is pretty much what we saw on Wednesday. Again, I think it was much more than just the yield curve ticking down, ticking inverted for a momentary period there. It is meaningful. Let me not say this, because I do think there's a lot of contradictions here in the markets. Somebody's going to be right, somebody's going to be wrong. The markets are telling you that they see recessionary potential ahead, and that the Fed's going to have to come in and lower rates to help out, which is why you would demand lower rates in the longer term than you would in the short term, which typically a yield curve is upward sloping, meaning that short-term yields are lower than longer-term yields because you're more certain to get paid back in the short term. That's sort of normal. Or in a growing economy, it's normal to expect to want some extra compensation to be tying up your money. Right now, what we're doing is we're importing a crazy bond market from abroad, with so much of European rates in negative territory and Japan, 0 to negative on a lot of their curve as well. And with those rates being, I'm going to say, somewhat artificial, where you have this huge presence in the markets, the bond markets of the ECB and the Japan Central Bank, it's very difficult to get real price discovery in bond markets. I think you have a global hunt for yield. And whereas stocks are telling you that there's a fairly rosy domestic economy and that U.S. companies should be able to make money, although with less enthusiasm than we had earlier, it's going to become very interesting to separate the global effects from the domestic effects when the U.S. economy diverges from the rest of the world. That's going to be the theme that's really going to see us through the next couple of weeks, and that's a very difficult one to resolve. I think be prepared for some more volatility in both directions in the coming sessions, particularly as we see quieter August markets, lower volume, but that also means lighter liquidity.